We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me this morning is Michael Gayed, portfolio manager and publisher of the Lead Leg Report. Thanks for joining me today, Michael. How are you?
I'm good. It's always a pleasure to be on your show because you always push me to think a little bit differently and deeper. So I'm good now that I'm actually talking to you.
Well, let's hope I don't let you down there then, Michael.
Well, and likewise, right? Exactly.
So, you have all kinds of different conversations. There's not many people that I know that have more conversations than I do, but you definitely blow that out of the water. So I want to start by getting your take on what the biggest threat right now to the markets are. Is a credit market crash? And, more importantly, the fact that most investors are too complacent to that risk at the moment. Is that the biggest thing on your mind right now?
Yeah, and it's consistent with a lot of the stuff that I said starting the year. I mean, I have to say, it's funny. It's like I got branded a perma bull in October of last year when I was screaming, the end of the world is at hand. That's why a stock market melt was about to take place. I was branded a perma bear early December of last year when I said, I believe the risk of an imminent crash is real, in December in particular. Stock market didn't crash, but it was the fifth worst December in history. I then was branded perma bull again in January, early January, when I said back to the melt up pre-election year, but that there's a credit event out there. And now again, I'm being branded a perma bear. In general, the biggest risk to markets is always one behavioral dynamic and one behavioral dynamic only, which is overconfidence. Right? It's like I always go back to nobody can tell what tomorrow brings, me included. There's a reason why I frame things in terms of conditions and not calls, because I don't know the mile marker I'm going to crash my car. I know that if it's raining, I better slow down and hopefully I'll avoid the accident. Right? So the way they look at the marketplace now is there is a lot of overconfidence in the idea that we're going to avoid a recession and in the idea that bankruptcy risk is not going to filter through into the bond market. Now, we're seeing bankruptcy filings pick up in the real economy. I mean, this is pure fact. We have not seen default risk getting priced internally in the bond market in a way consistent with what's happening on the ground, meaning the spread between high yield junk debt and AAA just keeps getting narrower, right? Which has been remarkable. I think even to the most bullish of people, it's been bizarre how incredibly well junk debt has held up relative to AAA. Okay, the thing is, and I just wrote a piece about this for Investor Place that's going to be out shortly. Junk debt is like volatility. It's like the VIX on a relative basis. Credit spreads correlate very well to the VIX, which means that it's very mean reverting. So when you have periods of low volatility, they tend to mean revert in terms of higher volatility, right? When you have periods of very narrow and tight credit spreads, that's actually the time to be most worried about credit spreads, right? So that's where the overconfidence is. The overconfidence is in the idea that these highly leveraged junk debt issuers, that there's no increased default risk despite the fastest rate hike cycle in history, the lags of those rate hikes, and then people just saying, you know what, we're going to keep on mooning on equities, while, by the way, most equities haven't really done all that well on a relative basis to inflation this year, other than the large cap, mega cap names.
Well, that's actually something like the next thing that I wanted to touch on was this idea of the concentration of the outperformers in the NASDAQ being so siloed to only a couple names, like let's say Apple or Nvidia. Does this also not pose a bigger risk of a market crash when everybody that's in those, handful of trades start to pile out of that particular set?
Yeah. Okay. So, and first of all, I've hammered this point a number of times. It's like if I've been wrong about anything this year, I'd argue I've been wrong about the melt up, which sounds weird, right? But the reality is, anybody that's watching this video or listening to this, as we're talking, here, all you got to do is go to any stock chart website and look at a few tickers, okay, for the year. Look at daily data on IWM, the Russell 2000 ETF. That is not a new bull market. Look any 5-year-old technician would see that, right? Look at a proxy for Europe, VGK, a Vanguard Europe ETF. Does not look like a new bull market. You look at emerging markets, CEM, does not look like a new bull market. You look at retailers, and XRT is the ETF, US equal weight retailers, which are supposed to benefit from the strength of the consumer. Does not look like a new bull market. So what's happened is everyone is being fooled by idiosyncratic risk, because now the what people perceive as the market, the S&P, the Nasdaq, to your point, it is being driven in a very outsized way by a very small number of mega cap tech companies, right, that you just mentioned. Now, it's obviously worked this year. There's no question about it. But the problem is, there's a very well known. I keep stressing this point. I'm very big on behavior, right? In the way I tend to think of things. I've read a lot of studies on behavioral finance and psychology. There's a very well known behavioral phenomenon called the disposition effect. Okay, which is basically this idea that when traders, investors are faced with uncertainty, the first thing they do is sell their winners in a portfolio. They don't sell their losers, because they want to get back to break even. Their reference point on their losing positions is where they bought, that price they bought at. Mm-hmm. Well, you only have a select number of really extreme winners this year that end up being sources of liquidity if you have volatility, if you have risk off, if you have any kind of heightened period. So the point is that the fundamentals don't need to change at all. They could even improve. But the behavioral element of the concentration was why the risk is very real, because if you end up having sort of en masse, a very sudden reactionary function by traders around volatility, and that results in selling the Nvidias of the world and the Microsofts of the world and the Amazons and the Apples, okay, you know what? Then it becomes a self-fulfilling sell cycle. Right? That's, I think, where the risk is highest. It's not about the longer-term fundamental case. It's about psychology.
Mm-hmm. Yeah, and how that ends up driving investor behavior in, such an irrational market. But Michael, I want to go back to a term that you've used a couple times here, and that's the idea of this melt up. So does irrational market sentiment qualify as melt up, or would it have to be more of an epic rally, let's say, that to an outside observer would look even more irrational?
Yeah, I mean, it's funny, right? Because like these terms, all of us throw them around, but they're not really properly defined. And one person's melt up is another person's bear market rally, right? Yeah. Which I'd argue is really what this has been. I would argue, and I've said this publicly, I still think we're in a bear market. We can talk about the reasons why, okay? And I still think this is one of the greatest bear market rallies in history, right? And I can show a number of things that, I think would prove that out. But it's like, all right, so you've had plenty of bear markets where the S&P goes up 20, 25, 30%. In the context of still lower lows that happen down the line, right? I mean, those are melt-ups. Those are fairly sizable, tradable rallies. There's no question about it. To me, a melt-up is not like S&P going to 10,000 or kind of the outlandish forecast that you see by people that have said the same thing for years, right? It's more just sort of, all right, it's a feeling of unrelenting FOMO without a real big change in fundamentals. I mean, the purest form, it's really more about that, less about percentages, more about the feeling of I need to chase. Right, which you can argue is what's happened, with the Nasdaq and with large cap names, but people need to, I think, be just cautious in terms of saying, "Oh, yeah." I had people say to me back in February, "Oh, where's your melt up?" And now they're saying, "Oh, it's a melt up." Like everyone's always extrapolating out the most recent past and not even properly defining what it is that they're characterizing the market as. To me, it's very simple. It's just FOMO, unrelenting, seemingly out of nowhere, surprising a lot of people. Credit event has a very specific meaning in terms of differentials between junk debt and AAA, but melt up is more of a term that just gets traction and attention, but people need to think about it, I think, properly.
Mm-hmm. Well, in the context of the idea of the melt up that you just explained, that really reminds me of the crypto market in a couple different times in the last couple of years here. Do you think that there have been a lot of investors that are now going to shy away from another type of, let's say, melt up in the crypto market because of the lessons that they have learned there?
So crypto is unique in the sense that there's been plenty of these massive drawdowns and then the bull rally reasserts. Now, having said that, going back to behavioral finance, there's something called the snake bite effect, right, which is once bitten, twice shy. Mm-hmm. So there's a reason why typically you don't see a bubble recurring back to back in the same sector or asset class, because people remember the pain of the deflating of the bubble as they're in that position, as their beliefs are not adjusting under new information with a Bayesian type of framework. And then that, as they take that loss and take that drawdown, then they say, you know what, I'll never touch this thing again. So that's why these bubble periods, they take a long time, not just to recover from, but to create confidence to actually step back in, unless you have like a new generation. Mm-hmm. Whether that's happened with crypto, with what happened from the 2021 peak, I don't know. It's very possible though, because that was very clear mania. I mean, there's a reason why I have the lumber and gold eyes, right? Because I put that up when the laser eyes were everywhere on Twitter, now X, in 2021. And you had all these celebrities, putting that stuff out on their own profiles. It became the cool thing. I think many more people were burned by this. And those that, to your point about interviewing a lot of people, those who I've interviewed in the Bitcoin space have said this is actually one of the more frustrating and longer bear markets that they've seen in, the somewhat longer than 10-year period that Bitcoin's been out and popularized. So, yeah, bottom line is I think it's possible that the crypto space would have a hard time to really recover en masse. Bitcoin might, as I keep saying, diverge, but that doesn't necessarily mean new highs, in the near future.
So, Michael, with disruptions in the Treasury market being warned about from economists within the Fed, we saw a major spike in the 2-year here recently. Do you have any more information on this, or was it just a glitch?
That's my new favorite word, I think, for the rest of the year is a glitch. I mean, it does look like it was a glitch. I mean, there's when I saw it, my first reaction, I was actually responding. Michael Kramer who turned me on to it on X. I said, that can't be right because equity futures were not down, right? So it's like, that was like a shock if it was a real print. Now, it's weird in that it looked like there were some trades that actually took place on that 2-year yield spike and it was changing. But if it was a glitch, it was a glitch. I made it very clear. I had a lot of engagement and also a lot of haters afterwards saying this guy doesn't know what he's talking about. Look how alarmist he is. First of all, nobody really knew what was going on. I mean, this is just fact in the moment, right? And I was myself reposting and liking things that were countering and saying it is a glitch. And others were saying actually it's not a glitch, right? For there to be a glitch in the world's most important asset, though, should make everybody pause, right? And the fact that in quotes glitch happened as these headlines were coming out, like you just alluded to, around economists within the Fed saying there are going to be these strange disruptions in treasuries because of hedge fund gaming, right? Of short positions. It's like, all right, well, I don't think it was that far fetched to think that something was really happening at the time. Now, had that been a real print, and I put this post out, which a lot of people ended up attacking, somehow missing the point. I said, if the 2-year yield print is real, when it spiked, I said the banks collapse tomorrow. This is Sunday when I said that. Now, that sounds really dramatic, but like that was the exact argument back in March with the regional bank crisis, right? That it was driven by, what looked like very irrational, illiquid treasuries and then the asset liability mismatches as a result. So I purposely said if it's real, the banks collapse. And obviously it wasn't real. Banks didn't collapse. By the way, that doesn't mean that we're out of a high risk period. Right. I mean, when you end up seeing a successive number of strange things happening, it's time to start to reevaluate what's actually going on. Right. And I would unequivocally qualify that as a really, really weird dynamic that happened just a couple of days ago.
Yeah, I think without a particular explanation that was, offered for that, it does, like you say, it does seem really weird.
Yeah. And it's like, as it's happening real time, nobody knows, and I was not getting straight answers from anybody. Right, on it. And I mean, it was actually really fascinating. It was almost like crowdsourcing of, like what's happening, right? And I was very, I was getting thankfully I got also a lot of followers and attention, but even I myself posted saying I'm as confused as everybody else, right? It wasn't like fear mongering, but it's just wild to me how people don't understand how important the speed of treasury movement is to the overall system and economy. Right. So you saw that with gilts, for God's sake. It's like to think that what happened in the UK can't happen in the US in treasuries overnight. It's like, all right, I'm sure a lot of people thought the gilt move was a glitch, too. Ended up being real. But in the moment, you don't know, is my point. Right. So it's worth still paying attention. Regardless, what's really interesting here, I think, about treasuries is if they are not the source of the credit events, either way, there's a setup for a massive short squeeze. And that's because you've got a lot of net speculative short positioning because of this basis trade by hedge funds, which have basically shorted the long end. right? Because it's been a profitable trade. And hedge funds, by the way, are no different than individual retail investors. They chase the last trade. They fight the last war. They fall victim to recency bias and overconfidence, just like everybody else. Mm-hmm. So if you end up having kind of a real short squeeze actually in the hedge fund space on treasuries, given concerns around illiquidity to begin with in treasuries, it seems like, yeah, you know what, there could be some stupid movement in terms of real gains to be made betting that yields fall on the long end, meaning long duration treasury prices rise very sharply. And again, I think that would probably coincide with a repricing of default risk, credit event, and a broader event that could shock everybody.
Mm-hmm. So, we were kind of tying this to the idea that all banks would fail tomorrow, as you were saying, if that print were real. Right. Do you think that there is, a major risk still out there in the banking sector?
Probably. I mean, it is weird to me to see that Schwab is not getting off the ground, the stock itself. And there's been some interesting analysis. I don't know how real it is, right? But there's some interesting arguments around risk that Schwab in particular might have in terms of its own book. Regional banks are not able to get out of their own way. So, it's funny. I get people saying to me, what would turn you bullish? As if it's like based on some bias. It's not based on bias. I'm literally just trying to look at various market movements, various relative intermarket relationships, and trying to interpret what is it the market itself is saying.
Yeah,
I would argue the market itself is saying there's a lot of pain still that's coming. Again, going back to small caps, retailers, emerging markets, Europe, the dollar strengthening, regional bank stock prices not recovering, bigger banks also not doing all that well. Oh, and by the way, now this time around, utilities confirming as a risk-off sector allocation, lumber to gold weakening. At the same time, by the way, this time around, home builders are confirming, which was one of the bigger disconnects. Lumber was weakening, but home builder stocks were on fire. Mm-hmm. Now they're kind of starting to at least directionally move in the same way. So I think everything points to massive credit contraction. And it's just the junk debt market is going to be the last to realize it. And then when the junk debt market does realize it, or those investors realize it, that it's the whole slowly then suddenly. It becomes a very sharp readjustment and repricing. And that goes back to the way markets historically worked prior to last year, which is staircase up, elevator down.
Mm-hmm. So speaking about, let's say, interest rates more generally, Michael, what's your outlook for central bank interest rates around the world? Do you see cuts from here sooner than later? Like, is this, 5.5 or 5.25% to 5.5% for the US kind of our ceiling?
Maybe, because I think you're seeing the same debt numbers I'm seeing, right, around government spending and government liabilities. And Michael Howell, I give credit to him, framed it, I think, very well of cross-border capital many times. Most crises are refinancing crises. It's on the rollover of debt when it's a crisis. Mm-hmm. Right? Now, that was my whole thesis at the start of the year for why a credit event would happen towards the end of the year, because a lot of loans were taken at very low rates post-COVID. They mature in 3 to 4 years. They're going to roll over 2024, 2025. The stock and bond market seeing that would respond on that before it happens as discounting mechanisms. And that then would force the Fed to pivot, because the stock market and the bond market says to the Fed, be very careful. This could be a big problem if rates are elevated for this long against a lot of these zombie companies that have to survive and may not be able to on higher interest expense. Like, that was the whole thesis to begin with. Obviously the reverse carry trade from the yen side now I think is a big risk, China, all this stuff. But the point around rates here is that the Fed itself doesn't know the lags, right? So I think if they keep pushing, it's going to be a real problem. The lags themselves will at some point resolve the credit spread dynamics, which I keep highlighting. That's not to say, though, that yields would not rise, right? So even if the Fed and other central banks stop hiking rates, that's just going to be on government yields on the short end. You probably still would have yields in corporate bonds rising, which again would be the repricing of default risk, the widening of spreads. So you can have central banks stopping. It looks like that's a saving grace for the bond market, but it's only a saving grace for high quality government debt, not for everything else.
Mm-hmm. Do you think there's like an order of operations to who cuts first and who proceeds to go next? It really seemed like the U.S. led this charge. Would they be the last to cut, do you think?
You know, it's interesting. I'd argue that Brazil was the first one to lead the charge, right? Because they were hiking rates way before the Fed, on the Selic, and they've started cutting rates. So, I mean, if recent history is an example, it seems like Brazil's actually the one that's foretelling what's going to happen next. And from a time frame perspective, it actually gets to be interesting because you can argue the Fed cuts rates next year, but the Fed probably doesn't want to be seen as being political in an election year. So who knows of how that factors into things? But yeah, the Fed, Powell, anybody that's at the head of a major central bank, they're all reacting, right? They're not anticipating. I disagree vastly with the idea that the Federal Reserve controls the bond market, vastly, because all evidence shows that they respond with a lag of around 2 years to what the bond market's saying. So, and that's historically a truism, not based on my opinion. So, whatever the Fed does is irrelevant because whatever happens next is not based on the next Fed hike and what the next path is for the Fed. It's the lags, right, that will impact everything.
That's a really good point, Michael. It's not necessarily about what the Fed does next, but it is, it's what the lags from what they have done in the past, what those start to manifest within the economy and the stock markets themselves that are going to dictate what they end up having to react to, right?
Which is right around now, right? So I mean, this is my point of the timing. So you can see interviews I've done back in January; they're still there. I've been consistent throughout this, saying, people forget there are lags, and that probably happens towards the end of the year. Like I've been very consistent in the path. I said very clearly. I've said I believe we see a melt up and a crash, which, by the way, there's precedent for. It happened in 1987. I keep going back to the 1987 example, not because I believe it's going to directly parallel 1987, but think about what happened in 1987. Okay, so 1987, everyone thinks about the crash, Black Monday. The problem is people forget that prior to the 87 crash, the Dow was up 38% on a year-to-date basis. There was a melt-up in 1987. The Fed was hiking rates in 1987. And by the way, 1987 was also a pre-election year. Then the stock market crashes. They blame portfolio insurance, which, by the way, it would not shock me at all if the equivalent of portfolio insurance as the scapegoat in 87, the equivalent of that this year is zero DTE manic trading. Because it's ultimately still about leverage and disruptions of the tail wagging the dog. So this year had a strong year, the NASDAQ and the Dow. The correlation to 1987 is around 0.85 path-wise at this point in the year. Everyone's assuming the Fed's not going to lower rates this year, but the year's not over. And 87 has proved that strange things happen all in a 12-month time frame. So again, it's not sort of a base case that you have like a massive collapse very suddenly like 87, but we know it's possible. And I'm blown away that people are not even willing to entertain the possibility that the path could screw everybody up. It's funny. I on Twitter X, I always stress it's a persona. It's loud. It works. People can complain about it, and people like it or don't like it, but it does get engagement. Get work. It does work. I fail to understand how people are unable to do scenario analysis. So you say something, people then attack. Well, they're attacking, which means they're making a forecast themselves that the most recent past will continue into the future. And yet, time and time again, it's been shown that that's not the way markets work, right? So, I think there's still a lot more surprise potential out there. Now, I could be wrong. Maybe the market keeps going up. Maybe there is a catch-up trade by small caps. By the way, I don't disagree. So I had people say, "Oh, I don't understand. You're talking out of two sides of your mouth. You're saying that there's potentially a crash credit event, but small caps are oversold, which means if you're going to be bullish, you actually want to bet on small caps." Yes, that's exactly what I'm saying. Markets tend to crash from oversold levels. Small caps are massively oversold. Yes, they could bounce, but it's in the oversold level point where the risk is actually the highest, right? So that's why this is so tricky. I can make a very, very bullish argument that you'll see a cyclical rebound. I don't think so because the leading indicators are not suggesting that. But the point is that we are one of those junctures where something has got to give.
Yeah, I think that's a perfect way to put it. As we're talking about all of the lags, and especially from interest rates, does the commercial real estate sector problem start to manifest here as well when these companies have to go and roll over their loans and really face that refi rate that's a lot higher than they have ever had to pay.
Yeah, I think it's going to be a slow motion train wreck. And I say slow motion because it's not bulleted, in terms of sort of it all hitting at once.
Mhm.
But it will have negative impacts. I think there's no question about that. And this is the thing, it's like, goes back to lags. The problem we have as a society is that everyone is so short term in their thinking, they can't, and everyone has like ADD effectively, right? They can't consider that markets can go up, that dynamic can be in the background and can still be a longer term headwind
Mhm.
for risk on assets, right? In terms of how that plays out. And that's going to be a long cycle, just like housing is going to be a long cycle too, right? So yeah, I think that's more of a drag as opposed to an event, right? I mean, that's probably the more accurate way to say it. Now, again, I could be totally wrong on that, right? But yeah, if I look to the possible sources or catalysts of tail risk, that one seems almost too well known to actually be it.
Right. You mentioned that the housing sector as part of that as well. Do you think that there is a bubble that few understand there at this point?
First of all, I've clearly been wrong on housing because I was sounding the alarm on housing weakening, and it weakened a little bit and then reaccelerated, right? And now you've got like some of these big banks saying it's actually going to reaccelerate even further. Okay. I keep going back to the thesis really should be that, at some point, if unemployment does pick up, and it looks like it's starting because of the lags, I can goes back to that, as well as student loan payments starting back up again, that probably means that the secondary and third and fourth homeowners, they are going to be forced to at some point sell because they're going to have to sit on vacant properties, and properties often, at the margin, housing is set from the most recent transaction, right? So, and that creates maybe a self-fulfilling cycle. I've argued that before. It's like the housing inventory problem gets solved with fear, right? Well, if you have unemployment rising, that's going to cause fear.
Mhm.
By the way, I'd argue actually the large cap dominance also gets solved by fear from an equity perspective, because if you have unemployment, some people may have to end up dipping into their 401ks and IRAs and pay the penalty to pay for all these inflated grocery items at the extreme. And because most people are in Vanguard large cap funds, at the margin, that creates some selling pressure, right? So it actually does ultimately, I think, go back to unemployment. But yes, I think housing, no matter what, just like commercial real estate, it's a long cycle. I think it's in trouble. And all the affordability stats, everything historically that you tend to see prior to a bear market in housing is there. It's not even debatable. I mean, this is just outright fact. The timing, obviously, is the tricky part. Now, that doesn't mean somebody should hold off on buying a home, right? It's like I always go back to nobody knows when it's their time, right? So you've also got to get utility in terms of living your life, and if you have a family, being in something you're comfortable with your loved ones. So yeah, you might be paying up for a house. You may want to wait, to buy that house, but the reality is, because you don't know if you're going to live or die tomorrow, you can't really make a decision on your primary residence based on where you are in the housing cycle. Mm-hmm. But for those that are actual investors in housing, yeah, I think it's going to be a real challenge.
Yeah. Michael, is there a real divergence in, let's say, consumer stock pricing and demand versus the oil price? How are the two tied, and what signal is that giving us?
Yeah, I mean, it's interesting, right? Because it's like oil's obviously been on a tear. I'm actually quite negative on oil here, which, again, I could be wrong. I'm wrong all the time, and just like I'm right all the time. I can't tell the future better than anybody else. But it goes back to, is it really demand that's driving oil? Probably not. It's much more supply, right? Maybe it's front running the refilling of the SPR, although I just saw some headline that showed that Biden is open to totally drawing down the entire SPR. I don't know if that's true or not, but I saw that, which is just mind-numbing if that's true. Mm-hmm. Nothing surprises me anymore by these knuckleheads, whether it's Republicans or Democrats. It's boneheadedness beyond belief. I wish there were more trolls diverting their attention to that as opposed to me, a guy who's trying to build businesses, right? But never mind that. So I don't think it's consumer driven. I do think it looks to be supply driven. And keep in mind, oil tends to have pretty aggressive spikes also prior to recessions, right? So I would view it more as a signal. The fear that oil is going to spark another bout of inflation, while I think that's valid, I think that gets countered with a credit event. A credit event would break everything, especially oil.
Mm-hmm. Because of demand.
Because of demand. Demand would just crater under that situation. Exactly right.
Right.
At a faster pace than supply is adjusting, I guess is the way to frame it.
Right. So, Michael, I know you've been speaking about Japan and the carry trade there. What can happen to their monetary policy and economy if oil keeps rising? With Japan being so dependent on imports, how do they deal with this rising cost?
Yeah, and so this is actually where I still think that's the ultimate source of the credit event, right? So everyone complains about the Fed being late to the game on inflation. There's no central bank later than the Bank of Japan because they're used to disinflation, deflation, right, for decades. So they imported their oil. Nuclear has been there's been more favorable responses by Japanese citizens to nuclear after Fukushima, but that takes time, right? So they're still obviously very dependent upon oil against yen, which is falling, which means that oil denominated in yen is basically appreciating at an even faster pace. Okay, so they have a real inflation problem. Rates are beyond stupidly accommodative still, right? The population is already getting upset with inflation in Japan. And I think at some point they're going to be forced to act, the Bank of Japan, to try to stem the yen's decline, to at least somewhat stem the acceleration of oil in yen by making the yen stronger. If the Bank of Japan does do something more aggressive, which remains to be seen, I get it. Everyone says they've always wanted inflation, but you don't want inflation unless it's wage inflation, and that's not really what's happening relative to everything else. But if the Bank of Japan were forced to act to try to save the yen, okay, that reverses some of the carry trade dynamic, right, where foreign money borrows at very cheap rates in Japan, deploys in other countries. The yen now rises, so now there's a repatriation back into the yen. There's a deleveraging, effectively a global margin call, which, by the way, the reversal of carry trade has always been a big catalyst of historically. I'm not saying anything that's new, right? And I keep going back to it's like the most important central bank is the Bank of Japan now, more so than the Fed, because while Japan is a small country and yes, obviously a still big driver of world economic activity, no amount of zeros has been printed from a central bank like the Bank of Japan, right? Cumulatively, so it's not the butterfly effect; it's the Mothra, right? That from the Godzilla movies is the analogy I keep giving. It's a thing that could really come out of nowhere. And I keep going back to it. Any kind of real credit event has to be something that almost has to be a little bit hard for people to understand, right? It's like, it can't be something that's obvious. It also can't be something that central banks can immediately front run. Mm-hmm. Back in March, a lot of people were saying to me as the regional bank crisis was taking place, they were saying, here's your credit event, you called it. I said, first of all, I don't think this is it. And I'm not calling anything. They can save the regional banks. And they did. Right? It was actually a fairly easy fix. And they did it very quickly. So everyone forgot about it, and then AI took over a month later. With the Bank of Japan, that's a much trickier thing for central banks to respond to try to contain, right? Just in terms of the ripple effect. So, yeah, I think oil, all eyes on oil, the yen, the BOJ. I think that's still going to be where the ultimate catalyst is for something.
If they do have to, keep paying this price for oil, though, is it possible that they end up having to sell U.S. Treasuries to kind of stem that slide?
Yeah, so that's been one of the interesting question marks, right? Is what happens in terms of holdings of Treasuries
going back to that strategy?
Right, exactly right. So would that impact the flight to safety trade, which I keep emphasizing? My funds are rules based, right? The problem I have is that people can't differentiate between me as a portfolio manager and me as a thinker, a portfolio manager of rules based funds, which have nothing to do with how I think. They're rules-based, right? They run the exact same way if I die tomorrow, but they all rely on Treasuries. So under that scenario, the question becomes, would Treasuries be the credit event, which is something which I alluded to also, right? That could be a reflection of the Bank of Japan selling into that. Maybe, but then at some point that solves itself by fear, because if that happens, what's the implication? What means rates are rising aggressively, even more so from an elevated level. What does that mean for mortgage rates? What does that mean for credit card rates? What does it mean for everything? So that then filters into other risk-on assets and then causes, I think, a flight to safety back to the Treasury. So the point is, it's not the thinking is correct that there might be pressure, but if the the flight to safety dynamic reasserts, the demand for treasuries would absorb, I think, the supply from the Bank of Japan.
Okay. Michael, we've spoken before about the importance of the gold to lumber ratio, and you mentioned it here earlier. Can you remind us of what that is and why it's a great indicator for risk on or risk off environments?
There's always people that like get confused by this, where they say, I don't understand why you're so obsessed with lumber, while they end up talking about copper and oil, and while they're commenting from their house, right, which has 16,000 board feet of lumber. I mean, the idea is simple, right? Lumber is a leading indicator of housing starts. This is not my opinion, by the way, and this is proven by others. And I have a whole paper that shows how lumber as the ultimate cyclical housing tell relative to gold, which is more of a safe haven risk off play, that historically tells you about volatility regime shifts. Again, not my opinion. This is based on the data. What's funny is that people will attack these narratives, not doing a single iota of research themselves to see if there's actual merit to what I'm saying, which there is, because anybody can look at the data and replicate the results. So lumber to gold now is weak, right, which is a risk off signal, right? Actually, the 13-week flipped last week. The shorter term, which is what my Roro ETF uses, flipped earlier, and that pressure continues. Now, let's play it out. Let's say I'm right about a credit event in the near term. Probably gold runs. I actually think I even posted that out a little bit earlier in the week. I said I think gold is going to look really interesting now, right? Because you're still around the prior peaks, but you haven't had any kind of real breakout, and it's just kind of meandering. Any kind of real flight to safety probably does benefit gold because it's among those risk-off assets, right? Gold, the dollar, utilities, and treasuries. Mm-hmm. So that means the lumber to gold ratio falls further because it's the divisor, right? Which would be even further risk-off as lumber itself keeps on weakening. So the broader point is that everything in my world is about volatility, right? And leading indicators to volatility. The irony is that the lumber to gold ratio has been unbelievably spot on in terms of signaling low volatility regimes, lumber beating gold, or high volatility regimes, gold beating lumber. What hurt in my world, especially with my funds, was the opportunity set. Because that's the way the prospectus is put together, such that when you're in a high volatility state for equities, risk off, you express that with treasuries, because historically, even prior to the 1980s, that's the choice, right? That's the thing that tends to do the best. Mm-hmm. So now it's going to be interesting to see. So if lumber to gold continues to be right as it has actually been the last 2.5, 3 years in particular, will this time around treasuries respond? Now, I hope so. That's my bias. I hope so, because that's what my funds are built on. That's my world as a portfolio manager. That's my punch in life. Maybe it's not going to be the case, right? But all I know is that the best diversifiers are the things that people don't want to touch. I can tell you unequivocally, people do not want to touch gold. People do not want to touch utilities. People do not want to touch the dollar. Okay, and people sure as hell don't want to touch the treasuries.
Why do you say that people don't want to touch them? Is that because they're not as sexy as the gains that we've seen in the rest of the stock market? Yes,
it's all FOMO. Mm-hmm. It's not just concentration of 7 stocks, it's concentration of a particular index against all asset classes. Mm-hmm. Listen, so I'm a part of Title Financial Group. So we're an RIA, right? And separate from my content on the Lead Lag Publishing LLC side, right? I'm part of this umbrella. My funds are under the umbrella. We launch ETFs. We're a white label ETF issuer, right? So we've launched 100 plus ETFs. We work with the largest and smallest ETF issuers that are out there. Everybody has had a hard time raising assets this year, of all strategies, of all asset classes. I mean, I'm talking about from the industry perspective, the business perspective now. Forget about markets, right? Okay, well, why has everybody had such a hard time raising assets? Because everybody only wants one thing, NVIDIA, and anything that's AI, because that's where the momentum has been. Now, by the way, that's starting to roll over. All right, but the point is that it's more than just sort of not wanting to touch gold. It's only wanting to touch one thing, right? Until that breaks. And then when that breaks, then everybody's going to want to chase some other new shiny object, and that shiny object could be gold. Mm-hmm.
So how do utilities play a role to kind of strengthen that signal as well, Michael?
So whether it's utilities strong relative to the S&P or lumber to gold weak, they both tell you the same thing. They both tell you about volatility dynamics shifting and becoming more likely to have higher volatility, more risk of a tail event in equities, conditions favoring the accident. Typically, and this is actually shown in that lumber to gold paper referencing utilities, when that signals risk off and what's the overlap against lumber to gold signaling risk off. Typically, in major declines, utilities will already be strong, outperforming, like we've seen the last 8 trading days. And lumber to gold will be weak at the same time. So in other words, they'll both give you the same signal of risk off, because they're both telling you inherently the same concept. Utilities are a defensive bond proxy. Lumber to gold is about housing, which is ultimately about demand for money and demand for construction, right? And demand for growth, right, in an economy. So the point is, like, now things are lining up again, right? So it's just another confirming signal that it's starting to rain pretty heavily outside. I don't know if an accident's going to take place. I'd say I'm loud about the credit event. I have fun with it also, right? Because it's like, what else am I going to do, right? Because it scares me too. Now, that sounds weird to say. I have these funds, which I'm saying I actually need a credit event for my funds to do well in, hopefully. It scares me too, because I could be right about a credit event, but if my signals for my funds, which are rules-based, don't capture it, or don't capture a big chunk of it, it doesn't matter that I'm right. The funds won't participate, and that's my world.
Right.
There's a reason why I keep saying path matters more than prediction. Right. The sequence is the question mark, not whether it actually happens. Right. Now, I built my strategies. I know the research. It suggests that, yes, most likely the path, hopefully those funds will capture it, ATAX, RORO, and JoJo. But I have as much anxiety as everybody else around it, because I don't know if it's going to happen or not.
Yeah, I think, being in this environment, there are so many confused investors, so many confused fund managers. What we've seen over this past 3 years has, I think, surprised like everyone. Do you think, in that environment, that the old flights to safety still hold as well? Because, the traditional ideas that existed before the last 3 years have mostly been thrown out the window.
Yes, although what I will say is that, and this is something that I am a deep believer in, and I think you can only believe in this when you've actually backtested a lot of strategies over very long cycles. You will always have rolling 3-year periods where something's not working. Always. You go back to the 1920s, you always have in any data set on a rolling 3-year period something which looks like it's dramatically broken. It's just not working. And I can promise in all of those rolling 3-year periods going back to 1920s, doesn't matter what strategy you're doing, any kind of backtest, right? People would say the same thing. Is there something different about the last 3 years, which is why this thing's not working? Right. So I'm trying to answer the question from like a data perspective, right? Historically, there are plenty of junctures where cycles just don't favor something, because no strategy works in all cycles, right? Now, the thing is, when it comes to treasuries in particular, what is it that gives me hope that the opportunity set behaves? Yields are higher. The starting point of risk off is at a much higher yield than what we saw 2 years ago. So whereas 2 years ago, trying to trade something like TLT, long duration treasuries, at very low yields, it's like squeezing blood from stone. You might be right about risk off, but because your starting point is a low basis point yield, it's volatile, right? Whereas now you've got much higher yield. You've got a lot of one-sidedness that's still very much against treasuries, very much against the flight to safety. It seems like that's actually the perfect time to buy a strategies after 3 years of it not working. Which, by the way, I mean, I can say that about my own funds, but that's just a truism anyway. There's something called the Morningstar curse. Forget about my funds, which have had a hard time the last 3 years, right? Morningstar curse shows that the funds that tend to do worse over the last 3 years that are 1-star tend to be 4 and 5-star the next 3 years, because they're cycles, right? It goes back to the rolling 3-year period dynamic. So no, I don't buy the argument that something's permanently changed. I really don't. Even prior to the 80s, treasuries were a safe haven, and now they're more likely to be because yields are higher.
Right. And does that also, that same thinking apply to gold, to the dollar, all of these quote unquote safe haven assets that people have always kind of gotten out of risk assets and into safety trades?
Yeah, I think so. The dollar probably is the one that would be the most interesting in terms of how much gas it has left in the tank, right? Because it was the clear risk off trade last year. Right? It's like a joke. That was the best inflation hedge, was going long the dollar last year. The dollar actually gets to be interesting because under risk off, which I think it's also signaling here with the appreciation, That's going to create some real strain in emerging markets, which probably explains why emerging markets are also doing so poorly, right? Not a new bull market still. I would argue that emerging markets become the best equity play to be after a credit event, because what would that suggest? It would mean the dollar has risen even further as the credit event's taking place. Credit event ends, there's a reliquefaction, the dollar then starts to drop. That actually benefits emerging markets on a relative basis, right? From a currency dominated basis. So of the four, utilities, treasuries, golds, the dollar, I suspect the dollar would be have the least upside convexity. I think the two that to really watch the most are going to be treasuries and gold.
Excellent, Michael. Well, that's, I think, a good place to wrap up today's conversation, unless there's anything else that you'd like to add, or any ideas that you want to bring forward.
No, the only thing I'll say is everybody make sure you subscribe to Tom's channel. Obviously, he's always one of the great interviewers. I always enjoy being on, and make sure you follow him and follow me on X, Threads, and all social media platforms. I believe deeply in diversification of where you put your reach. So it's more than just X at this point.
Yeah, we were kind of talking about that before we hit record this morning. And, I think we both make ourselves available on many platforms. And that's important now more than ever with, the ideas that we are talking about that seem to be controversial, even though, they need to be talked about.
Yeah, by the way, it's like I always go back to if somebody's saying something that you should disagree with, you should pay attention more. Like that's in life, man. That's beyond markets. It's like, for all the people that accuse me of being in my own echo chamber because I block people that are attacking me and not understanding that a criticism is different than an insult. You should be respectful of everybody's opinion, even if you disagree with it, as long as there's merit to it. And as long as you look to the left of the equal sign, which I always go back to, is what the real professionals do.
Well said, Michael. I totally agree with that. Of course, on Twitter at leadlagreport and leadlagreport.com, right?
Yes, sir. I appreciate it.
Perfect. Thanks for your time today, Michael.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.